So today we'll be discussing about the probability distribution curve and how you can get returns like this or this for your trading. So stick around. So probability distribution curve is used heavily by option traders, and they use this to calculate their deltas and how far away out of the money you want to get the option to sell the option or to buy the option and things around those nature. But it's not used by swing traders and day traders, and I think they are missing out on some great opportunities. The advantage of this probability distribution curve is essentially you get the odds in your favor, it gets the statistics in your favor, and you get to find trading opportunities which have got more statistical edge. So I'm just going to go to the probability distribution article in Wikipedia. I'm not going to go detail into everything, but I just want this thing here, this distribution curve here. So basically, for people who don't know what a probability distribution curve, I'm just going to summarize it. It's like the distribution curve for the people. Let's take an example here. Let's say the height of people in a classroom of the whole world. Let's say the height of the people at 15 years old. So the majority of the people will be somewhere between a certain height range. So let's assume it's 5'5" and 5'7". So 68% of the people will be in that group, and there'll always be a certain group of people which will be higher than that 68%. So that'll be outside of one standard deviation or two standard deviation if he's like 7 foot tall, if he's Shaquille O'Neal or something. And then there will be people in the extremely short height category as well. So the same way we could actually come up with different weights as well, like people's weight. And this normal distribution curve is basically seen everywhere, even in pandas and pandas' weights and animals and everything. So this statistical measure can be really good in finding great opportunities. So what I did essentially was I took the Apple stock data till 2018, just to give you an example on how the percentage change is being taken into a data frame, and then I actually calculate the percentage change in the normal distribution curve. So you can beautifully see this amazing normal distribution curve, similar to the normal distribution curve that we saw in our example in the heights in the Wikipedia picture. So we can actually calculate everything from like the mean to the variance to standard deviation. And now what I've got is I've actually got the graph here, and then on top of that I've drawn like a curve. So that kind of shows similarity to the normal distribution, and most of it average being around 0%, 0.00, or the mean. So now if I can draw a normal distribution curve on top of it, just to see how similar it is to the normal distribution curve, you can see it's pretty similar, except that it might be more percentage might be on the 0.00 percentage. But you can see the other two extreme levels, that's like 5%. So we'll be focusing on that 5% because that's where we'll be planning our trading ideas on. So by looking at this graph, I can see that the amount of trades that are below 5% or above 5% are very low. So I'll just look at the data, number of data that I have, and that's 2,264, and I'll just calculate how much data I have when it's below 0.05, and that's 13. Now I can go deeper and see how much is the data between 0.05 and less than 0.06, and that'll be just 10. So you can see the amount of information that I can get just from this Python software, but we're not going to go deep into it. It's only data from 2018, so the numbers are much less than what we have right here. But I'm just showing you, giving you an example on how I dissect this information and then come up with trading ideas. So anyways, we're going to take these 5%, and then I'm going to code this in TradingView. In this PineScript platform, I've actually done 5% decline, so I'll actually enter whenever I have a 5% decline, because that's what I'm looking for in the distribution curve. So let's see this trade here as an example. Before that, I'll just change the settings from one contract to 100% equity. So we've got 1,112% with a drawdown of 15%. The drawdown is a bit heavy, but other than that, the profit factor looks good. The percent profitable looks 50%, which all looks amazing. So let's take this example here, which happened on the 2nd of November 2020, and The previous day, the market had gone down by 5%. So that gave us a chance for entry, because the amount of times the market will be down below 5% is quite rare. And then once we are below that level, the chances for us to be above 5% is like massive. It's like more than the one standard deviation or two standard deviation. So you're looking at 60, 70, more than 70 or 80%. So I enter there and I exit. I'm not going to give away when I exit. Now, if you want to know when I exit or the reasons to exit, you can download the code. It's there in the description. So you can play around with the exits there. I've used a special kind of an exit, which can be helpful for you in these kind of strategies, but there are many forms of exit that you can do, but exit is really crucial. The number of trades in this strategy is quite low because we've chosen 5%, as you saw here in the distribution. The amount of trades, or the length, the amount of trades can go down. So mind you, this is just 2018, so the data we got here is to 2021, so the amount of trades will go up. So this is just for Apple stock. Now if you try it in any other stock, like let's say Microsoft, say for instance. So here we've got 103% and 34% drawdown. Now, the reason why this performance is not that great in Microsoft is because that 5% data that we've got from here is only for Apple. So this data is for Apple, and it's for Apple that we found out that 5% is kind of below the two standard deviation, or 5% is above that two standard deviation. But for Microsoft, this can be quite different. So for each stock, the strategies can completely change. Based on that, you have to find out whether it should be 5% or 10% or 2% or 1%, and that's the way you should create strategies. Now, it's quite difficult to find an accurate number for all the stocks, so you have to do manually for maybe thousands of stock to find out what the 5% is or what not the 5% is. So in my course, what I did is I've found out a number which kind of suits it, and I didn't use the average true range. I used something which is a derivative of the average true range, which takes the values of the daily ranges and calculates something based on that, and that has given me quite a great amount of return for that, and that result is only available in my course, and that's given 742%. This is for the SPY, and with just a drawdown of just 11%. So you can actually leverage this substantially. You can go 3:1 leverage if you're able to take out a drawdown to 33%. So then you will get almost 2,000% return, 2,200% return, or even go even heavier, go 44%, 4 times leverage. So then you're having a drawdown of maximum drawdown at 44%, and then you're having, you know, almost 3,000% return. So it's really difficult from a standard basis to identify which value as the average true range you have to use. You have to come up with lots of data. But if you want to do individually, like individual stocks like Apple or individual stock like Facebook, doing that probability distribution curve and trying to find out that extreme standard deviation might be a good platform to start with. Now, even here, the same strategy which I applied in Facebook, it seems to work with a minimal drawdown for 100% return. JP Morgan, it didn't work. Procter & Gamble, it worked. Visa, let's try Visa. Visa, it worked. Alibaba, Microsoft. Microsoft works pretty splendidly with 1,600, 45% drawdown. Walmart. And then, you know, it just keeps on going. So basically the idea is for each of the strategies that I've created, it tends to work practically in most of the stocks, but in order to find out that 5%, that can be a bit of a struggle. So if you want to perform strategies on a specific stock, I really recommend you find out what is that two standard deviation, and then you can work like a reverse engineer and try to find out which strategy can be suited. Now, like I said in the introduction of the video, this probability and statistics is used heavily by option traders, and there's a reason why option sellers are kind of successful to a certain extent, and that's because they are getting at least some of their statistics in their favor as compared to the day traders and the swing traders and the future traders. The problem is that they're not getting any statistics in their favor. They're just randomly picking a trade idea that's decided by somebody, and they're just trading it, and the only way they're using the statistics is in their risk reward ratio, and most of them, they tend to mess about in that front as well. So I hope you guys got an idea on how to come up with trading ideas from the probability distribution curve. You can come up with tremendous amount of ideas with the probability distribution curve. It can be like, instead of the one standard deviation, you can actually have multiple days below the one standard deviation, so maybe like 1 day or 2 days. So I've actually given the code of the first program in the description box, so you can actually download that and tweak it accordingly for your change, and then do it specifically for each stock, optimize it specifically for each stock, and get some good returns. Hope you guys enjoy the video. Have a great day.